Hello guys, we are back again with the fifth step of how to be a successful forex trader in 10 steps. In this video, we will show you the next thing that is very important to know if you want to be a successful and profitable trader. This thing is the structure of the market. We will take a look of how the trend is forming, what are the important levels of support and resistance, and when is not good for trading. Without further ado, let's begin. First, let's take a look what is the trend. Trend is the one of the two main movements of the market. It is a directional movement of the price. This movement comes from the big players of the market, such as the banks, large companies and others. This happens when they want to exchange their money in other currencies, just to make their profits in own currency. Another way is to make profit. There are two different trend movements in the market, uptrend and downtrend. Let's start with the uptrend. What is it and how it's created? If the demand of a given financial asset is more than the supply, the price rises and we have an uptrend. This means that the buyers are stronger than the sellers and they have control on the market. To be called uptrend, the price has to make higher highs and higher lows, and the new highs must break the previous structure. Now let's see how the downtrend is created. If the demand of a given financial asset is less than the supply, the price falls and we have downtrend. This means that the sellers are stronger than the buyers and they have control of the market. To be called downtrend, the price has to make lower highs and lower lows. The new lows must break the previous structure. Okay, let's move on and see what are the other types of movement of the price. Let's talk about the range. What is the range? Simply said, the range is a side movement of the price. There are no higher highs and lower lows. Range is a difference between the high and low prices in a given trading period. A range for an individual trading period is the highest and the lowest prices traded within that trading period. For multiple periods, the trading range is measured by the highest and the lowest prices over a predetermined time frame. Trading range refers to the difference between the high and low prices in a given trading period. Range-bound trading is characterized by prices staying in a definable range over time. It is also characterized by both support price and a resistance price, between which the price tends to fluctuate. The next type is the choppy market. What is it? A choppy market refers to a market condition where the prices swing up and down considerably either in short term or for an extended period of time. A choppy market occurs when buyers and sellers are in balance or when buyers and sellers are in a fierce fight but there isn't an overall winner. The price is moving up and down slowly or quickly and in large moves, but the price isn't making headway higher or lower overall. The price has ultimately moved higher, but the lower low likely confused the trapped many traders into making a losing trade decision. If this happens multiple times, the price may be making progress in one direction, but the large moves in the opposite direction may result in traders saying the market is choppy. Choppy markets occur on all time frames, from 1-minute charts to weekly charts. On the longer term charts, daily and weekly, choppy conditions tend to develop when there is a little market news driving buyers or sellers to be aggressive. On short-term charts, like 1 or 5-minute chart, choppy market often develops when volume drops off. The larger the choppy market price area and the longer it lasts, the more traders and investors are affected by it. The smaller choppy area, typically the fewer traders and investors are impacted. And let's take a look at the next important things you have to know, and this is the support and resistance levels. Guys, if you haven't seen the beginning of this series, you can watch it from the link in the top right corner. Support and resistance levels are one of the key concepts used by technical analysis and from the basis of a wide variety of technical analysis tools. The basics of support and resistance consist of a support level, which can be thought of as the floor under trading prices, and a resistance level, which can be thought of as the ceiling. Support occurs where a downtrend is expected to pause due to a concentration of demand. Resistance occurs when an uptrend is expected to pause temporarily due to a concentration of supply. Prices fall and test the support level, which will either hold and the price will bounce back up, or the support level will be violated and the price will drop through the support and likely to continue lower to the next support level. The concepts of the trading level support and resistance are undoubtedly two of the most highly discussed attributes of technical analysis. Part of analyzing chart patterns, these terms are used to refer to the price levels on the chart that tend to act as barriers, preventing the price of an asset from getting pushed in a certain direction. The explanation and the idea behind identifying these levels seems easy, but as you see, support and resistance can come in various forms, and the concept is more difficult to master than it first appears. Support is a price level where a downtrend can be expected to pause due to a concentration of demand or buying interest. As the price of the asset or securities drops, demand for the shares increases, thus forming a support line. Once an area or zone of support or resistance has been identified, those price levels can serve as potential entry or exit points, because as the price reaches a point of support or resistance, it will do one of two things: bounce back away from the support or resistance level, or violate the price level and continue in its direction until it hits the next support or resistance level. Determining future levels of support can drastically improve the returns of a short-term investing strategy, because it gives traders an accurate picture of what price levels should prop up the price of a given security in the event of a correction. Conversely, foreseeing a level of resistance can be advantageous, because this is a price level that could potentially harm a long position, signifying an area where investors have a high willingness to sell the security. As mentioned above, there are several different methods to choose when looking to identify support or resistance, but regardless of the method, the interpretation remains the same. It prevents the price of an underlying asset from moving in a certain direction. So guys, now you know what is the market structure. This is one of the most important things so you can make a proper analysis to be a successful and profitable trader. I hope you like this video. If you do, hit the like button, share this video with your friends and subscribe to the channel to be informed when the next step is revealed. If you are new to the channel, you can see the beginning of the series from here. Meanwhile, don't miss our weekly analysis on some of the most traded currency pairs. I wish you all the best. See you next time. Bye bye.